We heard from Jay Powell, seems to be making this big pivot here that perhaps inflation is not transitory anymore. There seems to be we're entering into a different macro environment now where liquidity is starting to dry up. How do you work around that? How do you position around that?
Well, yes. A more aggressive rate hike cycle is a major cause of volatility for second half this year, right? And we think it's going into 2022. The Fed officials, they have been increasingly view the inflation as a supply shock, so that ultimately will imply a more hawkish monetary policy. Yeah, so I think the market volatility will increase, and the emergence of Omicron is going to compound that, right? Because it increases economic risk and inflation uncertainties.
And so the place then in 2022 for, let's start with sovereigns, and we'll talk about credit in just a moment, because Chinese sovereigns have acted as an anchor, really, in terms of hedge and correlations. Do you think that correlation remains next year, that hedge, if you will?
Well, China is actually something we like next year.
Okay.
A lot of risk and market volatility this year for China are policy induced, meaning if they want to, they can relax some of the regulatory policy they in place this year, right? So, and China has been so far restrained in their policy easing, meaning next year they will have tools, more policy headroom.
Do you think they'll use the tools next year? Because the economy is slowing down quite a bit.
Yes, definitely, if they want to. But I think the policy rollout will be more restrained and targeted, just like this year, right? Maybe RRR cut, and also the relending quota, and also some of the special policy bonds. So you'll be somewhat constrained because they don't want to rely on leverage for growth. They want to support their policy growth next year with quality growth. Yeah.
We continue to watch what's been going on in the property market. We just are seeing here when it comes to junk bonds and dollar bonds, basically in the high yield space, where we've seen a top when it comes to yields. And you're seeing more of these global financial institutions and fund managers that are looking into the space very closely here and getting opportunities. Are you seeing more opportunities now?
Well, we are not saying we're out of the wood yet, but we see opportunities there at 20-25% yield that imply a default rate of 35%. But then risk the opportunity comes with risk, right? So next year, we still see opportunities there, but we need to be mindful, because next year, January, we'll see 10 billion of maturity next year, and 1Q and 2Q probably will see around 20 to 30 billion bonds maturing, both onshore and offshore. So the refinancing risk is high, and also the credit fundamentals are deteriorating because of the slowing sales and the slower cash collection and the margin. But then at 25% yield, we think somewhat is pricing of the risk. You just need to pick your spot and find a survivor that can go through the cycle.
It sounds so simple, right? Pick the companies that are able, that have the resources to pay their obligations, right? But the fact that we're here right now figuring it out, it means it's not as clear cut what indicators to look at. What are you looking at, financial metrics wise, to be able to pinpoint, this company's going to be okay, that company maybe not?
Well, we're looking at a company that has enough liquidity that can go through at least first half of next year.
Okay.
We look at the balance sheets, but because of a lot of hidden liability are off balance sheet.
Yeah, I was getting to that. Yeah. Because Kaiser had a lot of liquidity, right?
Yes. Oh. I think a lot of property developers, for the cash, they cannot really usable because of the regulator. They want to protect the buyers. So the cash collection are pretty much safe in the regulatory account, so they cannot really deploy it. And on top of that, I think a lot of banks, they're a little bit risk off, so that a lot of, they have to do a lot of refinancing, so that cash are going down. So when we do our analysis, we don't really rely on the cash. So we look at their cash collection to see whether they can generate enough cash to do refinancing. We like the company with less JV, so that there's less hidden debt on the off-balance sheet. So we do our own analysis on the cash collections. We have to monitor it closely. Cannot rely on the cash balance, and then look at the company that with less JV and off-balance sheet. And also, if company have enough internal resources, like if they can sell assets, if they have other property management company they can sell, and also the shareholder, if they they're willing to support the company, like doing shareholders loan and inject cash into the company. Those are the companies that we like.
You said 25% is still attractive for high yield. I'm just wondering, how much do yields have to lower in order to have a very functioning bond market, per se, for the developers out there? And when do you think that's going to actually happen?
Maybe second half of next year, when the yield decline to about 10 to 15% for normal functioning of the property sector. Yeah.
So you think yields will go down by half, will tighten by half, hopefully?
Hopefully, if the government somewhat ease a little bit, we don't expect it will have a major easing, but it can fine-tune its policy. And if one of the reasons that the sales are kind of slow is because the consumer is taking a wait-and-see attitude, right? So if the confidence come back and the sales start picking up, and then the cash collection from the banks somewhat ease a bit, that will help the property developer to recycle their cash and going back to a more normal operation again.